Joined by Mark Matthews from Bank Julius Baer. Mark, good morning. Good to have you on the show as always. Your thoughts on what's happening with the risk trade right now? Do you get a sense that we are seeing some sign of risk off, and we could see maybe the first round of emerging market correction?
I don't get that sense, but of course the market has been incredibly strong this year. I think the maximum drawdown in the market has been less than 3%. It's highly unusual. And so you would have thought, especially during the summer lull, that it would be an opportune time for the market to correct. But when I look at the NASDAQ in particular, because that's what's led the US stocks higher this year, it just seems that any time these big stocks like Amazon or Facebook go down, there's immediately people who come out and buy them. So as much as I would have liked to see some kind of a drawdown or correction, because those are always healthy for building a base, it doesn't yet seem to be occurring.
Morning, Mark. Let me quickly come to India, because we also are battling at all-time highs. The valuation catch-up earnings are not catching up with valuation just yet. There are too many disruptive issues like GST, for instance. Are you battling this valuation argument and therefore staying away from Indian stocks at all?
Do you know, I think that India, having just talked about technology stocks in the US, it has some similarities. Very expensive, but people are willing to pay premium, pay a high price for India for technology stocks. And so I think, if we are, how should I say, trying to buy things that are cheap and haven't gone up a lot, it might not be a successful strategy at this point in time, simply because clearly this is a year of growth and momentum.
Okay. Mark, hi, good morning. So this is a year of growth and momentum. I remember in your earlier conversations you did mention that you won't be surprised to see the Nifty even touch the 10,000 mark very soon. Would you still stick to that target? And by when do you think that could come through? And even if it does, what are the sectors that could lead it there?
Well, yes, I do think it can, and the market, there's no doubt about it, it's an expensive market. I looked at the valuation of the 900 stocks in India, so a very wide gauge, and on a trailing price-earnings basis, it's now on about 30 times. Back in January of 2008, before the crisis, it was on 15 times. So India's price-earnings ratio is very dear. But I think it can still go up. And maybe one thing that it will be helpful is, I believe, property sector. Now, property sector, of course, is not big in the stock market, but it has a big impact on people's sense of wealth, just like in the United States. Primary asset of most people is the home they live in. And I'm sensing with mortgage rates having fallen so much, and with property prices having fallen down to more affordable levels, and the Real Estate Act, which was passed on May 1st, that the pieces are being put in place for physical property prices to start rising in India, in which case I think there would be a wealth effect, and it would also be beneficial for the banks.
Okay. Mark, that's interesting. In that case, is housing finance also a sector to bet on, which clearly has been doing well in Indian market of late?
Yes. I think so. It would be probably my top pick in the bank space, because I don't see the corporate lending side picking up until capacity utilization gets up to about 80%, and it's currently still around 72.
Okay. If home finance is a space you like, would home building related materials also be of interest to you? Well, cement is the one that comes to the mind, but there are mid-cap companies like tiles and plywood.
Wouldn't be my top pick. I think really what I'm focused on now is the increase in affordability and the drop in mortgage rates. And so the first step would be really to look at the existing a secondary market in property. And then the next step would be to look at the primary market, but I think that'll be a little later on.
So the next big trigger, Mark, that everyone's looking at is GST and the impact that it would have in the very near term. But as a long-term watcher of India, do you think one needs to be perturbed at all, or will it, just be sort of a minor blip?
Oh no, I think it's a very important structural change for the economy on so many levels. I mean, it'll increase transparency and tax collection, but the most important thing is it will allow a lot of companies which can only do business in their state to go nationwide. And I can cite so many examples of things that get imported into India now because it's cheaper to bring them from China to, say, Tamil Nadu than bringing them down from, the north because of the complexities of the country's tax code. But if the flow across the states is smooth and equal, then I think it's very, very positive for companies spreading out their business across the country longer term.
Mark, how many times do you visit India in a year? This is such a perceptive observation.
Oh, no, not at all. I have Indian friends coming to visit me, so I'm stealing what they have to say.
Right.
I only go twice a year.
Okay, well, let me end with something on the global scene itself. We were just reading out a comment from the CLSA technical analyst, Lawrence Belanco. He fears that global markets are also seeing fear of heights. And he's particularly worried if the US 10-year were to plunge below 2.1 to 2.16 band, which is now the support, or if crude were to plunge below 41, then maybe the risk appetite will be reassessed. Do you think that scenario is something you'd worry about at all?
I think it would depend on the reason why the 10-year yield went down to those kind of levels. But all I will say is if you look back historically, and I just saw this chart the other day, I saw a chart from a company called LPL Research in the United States, and they plotted the relationship between inflation and treasury yields and the price-earnings ratio of the market going back to 1962. And what they found is that the lower the treasury yield, the higher the price-earnings ratio. So actually, and you think about it intuitively, it's true. If the treasury yield is low, that would attract more money to the stock market because you don't get as much money in fixed income.
Okay. That was some really insightful stuff you spoke about, Mark. And you did mention to us that you come to India only twice a year. I hope you increase the frequency and visit us in our studios as well.
Me too.
Next time you come. Thanks so much for stopping by and giving us your views.
Thank you.